Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
Hello, and welcome to the Prescribing Prosperity podcast with your two hosts, John and Alex Soutsos. Welcome, guys. Good to see you.
Bill, good to see you too.
Nice to see you, Bill.
Yeah, this is a good topic today. I mean, the last episode, if you'll remember, for those of you who are following along at home on their podcast, we focused on the tax and estate planning aspect. But today, we're going to focus on retirement planning, which is important because to ensure that you reach your retirement goals, there are some risks that need to be navigated. And those risks include a myriad of things, including investment volatility, behavioral biases, getting inundated with all those voices and noise from the media, from which, full disclosure, I used to be a part of. There are a lot
You're a
of
good guy now, though, Bill.
We won't hold it against you.
Oh, thank you so much. But the point here being, there are a lot of risks that need to be navigated on the road to retirement. And today, John and Alex are going to be our financial Sherpas, if you will, and guide us through the noise to the promised land. Boy, I certainly hope. So, John, let's start. And perhaps the best way to do that is establishing what some of the common risks are that investors face on the road to retirement. And I mean common risk aside from those noisy voices from the media.
Right. Well, I think the behavioral biases are probably the biggest risks, and the investment industry and individual investors really are not focused on those. However, we will deal with those a little bit later. For now, we're going to start on some more concrete risks. And if I start off, I would say, given what has transpired over the last 3 years, I would say inflation risk is something that has raised its ugly head for the first time in a long time. As we all know, inflation was in tame levels over the last 20 years leading up to 2022.
Yeah.
And since then, it's gone crazy. And people have to realize that when you're investing for retirement, you're at a starting point. Retirement is at a predetermined end point of your working career for most people, not for everyone. Or in the very least, you go from full employment to part-time retirement. But the long and the short of it is you're not working full-time any longer. And so you have to accumulate your savings and your wealth and have it grow as much as possible during that stretch.
Yeah. And you know what? Can I interrupt you for a second? Because I want to underscore this inflation risk, because I don't think a lot of people understand what the level of inflation does to their return on their investments, because it's a negative, and it reduces the amount you get in return on your investments, because you are now fighting, in essence, an economic reality.
Yeah, it results in a permanent decrease in your purchasing power, which is something that we've obviously observed, as we mentioned, over the last 3 years. You know, we're in somewhere in the neighborhood of a 20% permanent increase in our cost of living. And if you have not saved enough money and you don't have enough, your rate of return is not sufficient in order to compensate you for that elevated cost of living, then a lot of people have to make some hard decisions and really take a step down, or consider taking a step down in their standard of living, if they're not going to be able to continue to earn money and bring in resources to help offset that decrease in their relative purchasing power.
Yeah. And inflation is hitting home to the people at the lower end of the income scale especially in places like California, where the powers that be have decided to raise minimum wage to levels that incentivize employers to reduce their labor force, but also therefore increasing costs even more so. Inflation becomes even worse in that situation. But to bring it home, the cumulative inflation risk over the last 3 years has been, depending again on where you live, but on average over 3 years, about 20% cumulative inflation. So everyone's standard of living, it doesn't matter how rich you are or how poor you are, your standard of living has been reduced by 20% by the stroke of a few. I was going to say by the stroke of a pen. We don't use that expression much anymore, but by the stroke of several key punch strokes across your keypad, inflation has removed 20% of our purchasing power. And those at the upper end of the income scale can deal with that. But people at the lower end of the inflation scale cannot deal with that. And I was speaking with a client today about McDonald's, and I was saying how demand for McDonald's products increase during a period of economic contraction because people have lower incomes. And they pointed out to me, well, you know what, John? Even McDonald's is becoming out of reach for low-income individuals in the last few years, and that's very true. So that's how damaging inflation is when it comes to investing. If you think about it, if you have a 20-year time horizon in front of you before you stop working, if you have a 10-year time horizon in front of you, if you even assume a 3% annual inflation rate without the impact of compounding, that's a 30% reduction in your standard of living over 10 years. And if you get an anomalous period like we had the last 3 years with the response to COVID, then you can compound that 20% onto that 30, and now you're at 50%. So if you're retired and you're not working, that's going to kill you financially in retirement. If you're trying to approach retirement, it's the equivalent of running a marathon. The finish line is within sight. You're exhausted. You're drained. Your sweat's pouring off your brow. And as you're smiling, as you see that finish line, you see a couple of guys picking up the finish line and moving it away from you by another mile. And you just at that point don't know what to do. Do you just drop from exhaustion, or do you keep going? And that's what inflation risk does in the investment business. If you look at what in the US certificates of deposit, in Canada, guaranteed investment certificates, over the long term, the last 25 years, they've averaged maybe 2% a year, 3% if you're lucky. Recently, they're a bit higher, but that's temporary. We know that. So if you're looking at a 2.5% interest rate on CDs or GICs, and even if with 10-year bonds for a good 2 decades, they were hovering in the 2% to 3% range. Well, inflation takes all of that away. So your money actually doesn't grow. And if you are saving outside of a tax sheltered plan, then the government's going to take another chunk away for taxation. So you're going essentially backwards. And there's only one or two things, there are only a couple of things that can help you with inflation risk, and that is ownership of real assets in the form of either real estate or in the share of ownership of real businesses. The businesses that you may frequent on a weekly basis when you go grocery shopping, or the businesses that you utilize on occasion when you're getting new clothing or a new car. So when you own shares of successful businesses, the value of their revenue streams increase with inflation over time, and you share in that increase of their revenues by virtue of owning a share of a company that rises in value. And so inflation risk will stop you from getting to your retirement goals. It can impede your retirement lifestyle significantly. And the only way you can offset it is by having real ownership of real assets.
Well, John, in talking about this inflation risk, underscores something that you stated early on in the conversation, which is it amplifies the fear a lot of people have when they get ready to retire that they're going to outlive their money. I guess we could call that longevity risk.
That's right. So longevity risk is something that most people who are either on the cusp of retirement or are already in retirement, they don't think about this at all. So when I entered the investment industry as a very young man, I met a very wealthy retired woman who owned several businesses.
Mm-hmm.
And in the course of me explaining what I do for people, I used the phrase long-term investments, to which she replied by sticking her hand up in my face and peering down over her reading glasses like Katharine Hepburn and On Golden Pond.
There's a current reference.
Lucky you.
Everybody listening to a podcast is sure to have seen that movie.
Absolutely, Alex. Where have you been? Come on.
Everyone listening to this podcast has grandparents with reading glasses.
Okay.
So do we have like Morgan Freeman looking over his reading glasses?
There we go.
Okay. So she
Voice
says,
of God.
yeah, that's right. So she replies to me, young man, I don't buy green bananas anymore. Don't talk to me about long-term investing. And to which I replied, well, that may be true, but think about this. How old are you now? And she said, I'm 74 years old. I said, if you owned a portfolio of stocks and you died tomorrow, what impact would that have on you? And she thought for a moment and said, nothing. I said, that's right. However, if you live 20 more years, what would you be concerned about? Oh, I want to make sure I have enough money. I said, that's right. So your risk in holding investments, especially in of securities or stocks, is not of stocks fluctuating in price on a day-to-day basis. Your risk is inflation and for you to outlive your money. And that's what we call longevity risk.
Yeah. Well, the other part of the longevity risk too, is if you haven't saved enough to get there.
Yeah, if you haven't saved enough
when you arrive, you're in trouble.
Yeah, and let me tell you, Bill, in my 38 years of experience, I would say less than 1% have saved enough for retirement when they arrive at retirement. And so what ends up happening is they cannot invest in a conservative manner, which is what the normal default psychological mechanism is for individuals, is to be more conservative. They are forced to take perhaps a more growth-oriented strategy against their comfort level. So longevity risk is huge. The other risk, and considering who's been running the show the last 4 years and on both sides of the border, taxation risk.
Yeah, God.
So taxation risk, in my humble opinion, is legalized theft, but it's a reality of living in the developed world. And when you earn a dollar beyond a certain threshold on both sides of the border, you're having to give up something to the people who protect us. To use a Jersey reference. And so here in Ontario, beyond a certain income threshold, you're paying 53.53% to the government.
Ooh.
And even if you're, I know that you're in the U.S. You're from Texas originally, so you understand the difference between taxation.
Oh,
so
that hurts.
Even even for people who are earning between $80,000 and $200,000 here in Canada, tax rates are still up around 45%.
Wow.
So you're getting a dollar, you're giving 45 cents to the G-man, you're keeping 55 cents. Now you got to fight inflation. And from that, you got to pay your overhead, which is your house and your car and your transportation. Saving money becomes extremely challenging.
Yeah, which creates another risk, doesn't it?
And that's right. And so here in Canada, we have the benefit of having certain tax shelters that assist us in accumulating wealth. And we have a retirement account called a registered retirement savings plan. In the US, it's the individual retirement account, and 401k for the group plan members in the US. And we also have another savings program called tax-free savings account where people can put in $7,000 a year. And that limit is increased periodically by the inflation rate to help us accumulate savings. The lifetime accumulation contribution limit right now is at about $95,000 and growing every year. So that's a good thing. I think you have something in the US called a Roth IRA that is similar to that.
That is correct. Yeah.
Yeah. Yeah.
A Roth
So,
IRA is money that you put in after taxes, and the money in the Roth IRA grows tax-free.
right.
And when you take it out, it is free of taxes as
Right.
well.
Yeah.
You
So
pay the- you pay
that
going.
is so essentially the TFSA here in Canada, tax-free savings account is the Roth IRA in the United States. So these are legal programs that we're permitted to contribute to help us accumulate savings in a tax-sheltered environment. And some people I have dealt with over the course of time have said, yeah, John, but when you take it out in retirement, you're going to pay tax on it. So what's the difference? Well, the difference is tax-free compounding. When your money can grow tax-free for 20 or 30 years and compound tax-free over that length of time, even if you pay taxes all at once in retirement, you're still much further ahead rather than taking your 45-cent dollars and trying to make them grow.
Yeah. No, that's a very fair point. Very
So
very fair
that's really
point.
important.
So in terms of risk, there's longevity, inflation, insufficient savings, taxation. You hinted at volatility. We'll get into that in a couple of minutes. But I'm sitting here looking at notes, and I'm kind of curious about these last two. One is the naive diversification risk. What is that, John?
Okay, so this is something that might be uniquely Canadian. Here in Canada, we are our banking system is dominated by 5 or 6 very large banks, and they've been on the street corner across the country for over 100 years. And these are the organizations that people in Canada love to hate, but trust implicitly because they're very solid. And so when they have money to invest, they'll put some money with one bank and then they'll have some money with another bank. And they're investing in similar instruments. So these days, as you have in the US, there are what we call all-in-one portfolio solutions. So if you have money to invest and you see a financial advisor and it's at a banking institution, you're going to fill in the questionnaire. You're going to get scored on a risk-reward trade-off basis. And 98 times out of 100, you're going to score in what we call the balanced category. And that means 60% stocks, 40% bonds.
Oh, yeah.
So you might go to, and I'm not going to give corporate names, but we'll say ABC Bank, and they'll give you their ABC balanced portfolio.
Gotcha.
60% stocks, 40% bonds. And they're on the stock side, it's diversified. Some in Canada, some in the US, some in Asia, some in Europe. And on the bond side, it's in Government of Canada bonds that mature over 10 years.
Mm-hmm.
And then you go across the street to the DEF Bank and you go through the same process and they put you in their version of the balanced portfolio.
Gotcha.
But what ends up happening is all of these banks use the same portfolio construction techniques.
Yep.
And so in essence, you haven't diversified yourself. You've diversified yourself. You are so diversified to the point that you're reducing your opportunity to actually make any money. You're going to make some money, but it's going to be at a very slow pace. But people do this because they genuinely think that if this ABC bank goes bankrupt, at least I have my money in DEF Bank.
Right. Yeah. Yeah.
Well, the truth is, if you're in an all-in-one portfolio solution, you don't have money in either of those banks. You own a portfolio of stocks and bonds. And so even if the bank went bankrupt, it doesn't make a difference because the money is being held with a third-party custodian.
Yeah.
And it's invested in those underlying instruments. So you're not diversifying yourself. You're creating complexity. And people do this all the time. And before mutual funds were popular, they would do it with guaranteed investment instruments or your CDs in the US. Now, in the US, different banking system, different rationale. But in Canada, you'd be going around and scattering it amongst the big 5 banks. They all have deposit insurance of $100,000. First of all, I don't know anyone who makes $1 million on guaranteed investments. anyone who has any substantial amount of money has made it by owning businesses or
Mhm.
owning real estate.
Yeah.
So it's naive diversification to go to multiple banks for multiple all-in-one portfolio solution, and it doesn't have to be banks. There are private companies here in Canada, as in the US, or large organizations that are very well known that have their own versions of the balanced portfolios. And it doesn't matter if you put your money in that balanced portfolio or the other balanced portfolio, you have naive diversification.
To say nothing of the additional complexity that it offers you or creates in your life. So one of my dad's old clients actually had forgotten, he had spread his money over so many institutions. When he passed away, he had forgotten about money that he had invested at a bank in the United States. Wasn't it, Dad?
Yeah, so obviously he was gone, so he didn't forget.
Yeah.
Well, yes, but you know what I mean. Like
his widow walked into my office. She had a cardboard box, and she put it on my desk, and she was in a panic. And she says, "John, please help me. I don't know what to do with this stuff." And so there's this big box sitting on my desk with a bunch of papers and envelopes, and then I spent the rest of that day and 3 other days going through each one, and I found out this man was so concerned about financial security. He had money scattered everywhere in Canada, different cities, money in the US, everywhere. So it took me a while to repatriate all of those different assets and consolidate them with us in our portfolio system.
Yeah.
So that
to,
is
to say
that is
nothing of the
definitely a
fact
problem.
that it also creates complexity when it comes to managing a strategy. You don't have a consolidated strategy. You're relying on several different individuals, advisors, portfolio managers, etc., depending on who you're dealing with, to come up with a consolidated plan for your investments. And so you can have competing strategies at times, and that can create complexity and that can create issues. And you can also have issues where, with registered plans, there's contribution limits that are in place. And
Yeah.
in Canada, I'm sure it's the same thing in the United States. You don't have an unlimited contribution opportunity to those registered plans. And so as a result, you're then required to maintain or keep track of your contribution limit across several different institutions. And if you exceed those contribution limits, there are financial penalties to be paid. And so it creates a lot of complexity that I think people underestimate.
Well, you know what?
That
I think a lot of this, guys, in the spirit of moving this along, I think a lot of this is created by the last sort of risk here on the list, which is the emotional one. Because the reason the guy, John, that you're talking about had diversified everywhere was he he had some emotional biases, and he was concerned, and he was maybe not acting out of rational reasons, but more emotional reasons.
Yes, emotions are the biggest issue when it comes to investing. There's an organization in Boston named Dalbar that conducts survey on an annual basis, and they've determined that the behavioral bias risk results in a gap of performance between the underlying investment and the actual results attained by the investor.
Yeah.
And they call it the behavioral gap. And that gap oscillates around the number 3 or 3% a year. That's a huge number. If your returns in your all-in-one portfolio solutions gravitate to a 5% return, and then you don't get that 5 because you're oscillating 3% or 2% below it, then what's the point of having your money in any of these professionally managed solutions? And so part of that is a consequence of the do-it-yourselfers who are trying to save money and jump in and out on their own without proper guidance. And that's a reason why you should have professional guidance, is to create emotional distance from your money, because it's, for the majority of the population, it's impossible for them to create emotional distance between themselves and their financial assets.
Oh,
And so I will, of course, during periods when the market is dropping, get a few people who are panicky and say, the doo-doo's hitting the fan. I turn on the news and I hear all of these terrible things, and maybe we should pull the money out and keep it on the sidelines until excuse me, markets stabilize, and then we can put it back in later. The truth of the matter is, There's no one who's going to ring a bell and tell you the risk is now over. There's no one's going to ring the bell to say now it's time to go back in. And so what ends up happening is people stay perpetually on the sidelines. And so they mistime it. And so they end up missing on the opportunity.
One of the things I want to get into here really quickly before we move on is nowhere on that list, Alex, was the word volatility mentioned. And it's kind of implied in John's last comment that markets get volatile. People want to, in the lovely parlance of traders, people they want to puke out of a position.
Yes. Absolutely.
But volatility is real, but you don't have it listed as a risk, John and Alex.
Well, that's because volatility, in my opinion, is not risk. Risk is the potential for permanent loss of capital. And so if you put your money into an illiquid investment and you can't get your money out, that's real risk, that you can potentially lose all your money. Even if you put your money in a liquid investment that trades on a market somewhere, whether it's a stock market, a bond market, or a crypto market, you can lose money. It can go to zero. But if you own a high quality business or a portfolio of high quality businesses, the fact that the value of those businesses change on a daily basis on the market does not mean that's risk. The only way you're going to lose money in a well-structured investment strategy is if you choose to sell when the value of the investment drops below what you originally invested or drops below what it was last week. And you say, well, I'm going to sell. And if it dropped below what it was worth last week and you've been invested in for 20 years, you didn't lose anything. You lost some profit, but you didn't lose your original investment because you started. So I have this discussion every time there's a big drop in the market. I have this discussion with some of my top clients. So I have one in particular who tends to worry a lot. And they'll say to me, oh, in the last 3 months, John, I've lost $400,000. It's a large account. $400,000, that's awful. And I have to remind them, yes, but you've made $2 million. So the fact that your portfolio's declined 400,000 doesn't mean you've lost any money. You've just given up some of your profits. You're well ahead of when you started. And it's all proportionate. If you started with 100 and it's gone up to 500,000 and pulls back to 400,000, you're down 100,000 from the peak, but you're still way up from the beginning. And this is an emotional bias called anchoring bias. Investors tend to anchor to the highest number. And once it reaches a certain peak and then pulls back, in their mind, their original capital is now that higher number that they've anchored to.
Because they made that much. They quote unquote made that much money in their mind.
Yeah, that's right. So I here in Southern Ontario, where residential real estate has been a very profitable investment for a long time, I remind people, I said, okay, the house you're living in today, how long you been there? Oh, 30 years. What did you pay for it? Well, I paid $100,000 for it. And what's it worth now? $1.5 million. Okay. So let's say the real estate market is soft and you can't get $1.5 million and you sell it for 1.2 million. How much have you lost? Well, I haven't lost anything. I paid 100,000. I said, that's right. But you're down 300,000 from your peak. So you're totally rational when it comes to your house, but you lose your mind when it comes to your investments. You can't see the same comparison.
No, it's a fair point. That's a fair point. But that kind of underscores this notion of underscores the point you made about emotional biases, because money's emotional. Let's face it. Money's very emotional for most people. Look, I manage a significant amount of my portfolio, and every day I have this conversation with myself. Sell it. No, don't sell it. I go back and forth, and I go back and forth, and it's like crazy. And it's because, nobody likes to see the value of their investments go down. So Alex, why don't you just talk about a little bit about behavioral biases and emotional bias and how that works for investors?
Sure, absolutely. So, simply put, just as a brief overview for people, Emotional biases are distortions in our thinking or thought processes which are caused by our emotions, and they prevent us from making rational decisions based on objective information. And as you mentioned, Bill, we see that play out in all walks of life. You see it in your own
Oh, yeah.
activities when you're managing your money, and we see it in other areas of our life too. But there are I believe I don't know the exact number off the top of my head, but there's roughly 100 biases, emotional biases that have been observed by behavioral scientists. We focus in the financial industry on a handful of them because they're the most common that we observe. So
Yeah.
one thing, for example, is familiarity bias. So here in Canada in particular, and I don't know if this applies as much in the United States. It seems to be more of a phenomenon here, but people invest only with and in areas where they're familiar. So from a geographical standpoint, they want to invest in Canadian companies. In other situations, they invest in companies that they're familiar with, that they see on an everyday basis. They see, oh, I have an iPhone, so I'm going to invest in Apple. Or they're biased towards the companies that they work at. That's a big one, actually, and one that we're going to touch on in a moment. But, people think, the company that they work for, because they have greater familiarity with it, they feel more comfortable investing large sums of their portfolio in those companies, and that can create a bit of a blind spot and open them up to some potential risk. But as I mentioned, we'll get into that in a little bit more detail momentarily. Recency bias tends to be a very, very common one, and what recency bias is you tend to overemphasize recent events to explain the near future. So, to
Yeah.
give an example, it rained for the last 3 days. Therefore, if somebody asks you what the weather is going to be like tomorrow, your natural answer is most likely to be it's going to rain tomorrow, or the market
That's
declined.
unfair because it's been raining where I live for weeks on end. So
Here too, Bill. It's been dreary at times here,
it's like,
but
holy smoke.
It's sunny today.
yeah, today's a good day. But that's human nature. We tend to extrapolate what happened in the recent past out into the future, and that can lead to some very distorted perspectives.
Yeah.
Endowment bias. I always give the example. So endowment bias is the technical definition is it's investors psychologically value current investments that they own over ones that they don't. I always give people the example of fantasy football. I play a lot of fantasy football with my friends, and so you always think that the player on your team who's having a really crummy year is going to turn it around. You know that he's a good player, and you know he's on a good team, and he's got a good quarterback. And if
I
you could
believe
just,
in this guy, damn it.
yeah, if you could just get a few more targets, then his value is going to go through the roof. And we do the same thing with stocks. People look at it and they say, the second I sell, it's going to turn around, and I'm going to be kicking myself. And sometimes the truth is it's just not a good investment at this time, and you're better to cut your losses than to continue bleeding further, and you can
Yeah.
find other opportunities to get value in the meantime. So that's another one. Inertia or status quo bias, that's another one that we see a lot, a lot with people. And it's, when faced with new information or a wide variety of options, investors choose to keep things the same, thus creating an opportunity cost for missing out on
Yeah.
better investment strategies.
It's kind of like the devil, right? It's
Exactly.
Yeah.
And it takes some effort. It doesn't necessarily take a lot of effort, but it takes some effort to make a change. And a lot of people would rather just, slough it off and say, I can't be bothered. And that can create some significant risk and missed opportunity for them. So,
Well, it's emotionally painful to admit that you've made a mistake. And I think
No
that's where
kidding.
I think that's where that bias is rooted. Is you don't want to admit that, hey, I made a bad decision. We
Yeah.
all want to reflect on our good decisions. It's like the guy who goes to Vegas and comes back, and his friends say, "Oh, well, how'd you do in Vegas?" "Oh, yeah, I went to the blackjack table and I won so much money." "Yeah, that's great," but he doesn't talk about the fact that he went to the roulette wheel and lost 3 times more than that, right? So they'll never admit their losses. They will only brag about their
Oh, yeah.
wins.
Oh, no, totally.
yeah, exactly. So, that ties perfectly into our next one, which is regret aversion bias. People avoid making changes for fear of making the wrong decision. It's not just about admitting that they may have made a mistake. They don't want to make a mistake in the future. And so in an effort to avoid another mistake or potentially making a mistake, they just do nothing.
Yeah, they don't do anything. But unfortunately, Alex, that leads to another one, which is the FOMO. So,
Hmm.
which is dynamically, opposed to what we're just talking about. You're afraid
Yes.
of making a mistake, but you're afraid of missing out. Oh man, that's a hell of a place to be.
Some people can paralyze themselves with overanalyzing these things, but yes, fear of missing out is one that I think has become more prevalent in the social media age because we're just inundated with information and people see because everything gets amplified to a greater extent. People think that the opportunity cost of not doing what everybody else is doing is just enormous. So a current example would be the Magnificent Seven. Everybody and their cousin is saying, "Oh, why don't you hold the Magnificent Seven in your portfolio right now if you don't currently hold it?" And oh my God, I should be going out and buying the Magnificent Seven. It doesn't matter what the relative valuation of them is. And the truth of the matter is that may not be the right strategy for you. This may not be the best time to go out and buy those investments. Not to say they're not great companies or have great underlying fundamentals, but you also have to look at it from with the cost, what you're going to pay for that investment. Is it the right opportunity relative to their current valuation? And sometimes it's not. I remember as a kid, this is going to be a very Canadian example, going to the hockey rink for practice, and all the parents standing around talking about Tim Hortons because Tim Hortons at the time was blowing up here.
Mm.
The coffee shop chain for the uninitiated in outside of Canada.
Coffee and
No, there's
donuts.
some in the US.
I know, I know.
Actually there's one like about 12 miles from me. As a matter of fact.
There you
Well,
go.
there you go. So Timmy Hose was on the rise in the late 90s, early 2000s, and everybody was saying, "Oh my God, I got to be investing in Tim Hortons. I got to go and open up a shop myself. I got to get a franchise." And I remember, I think it was my dad who must have said to me, if everybody's talking about it, then they've already missed the wave because the market's become saturated and it's ripe for a correction. And he was absolutely right about that. And not to say that the company hasn't done well since, but the outstanding popularity that they were experiencing at the time has petered out, and they've become a stable, mature organization. Nobody can grow at an exponential rate of perpetuity.
Since Alexander brought up the Magnificent Seven, as someone who grew up on that franchise, I can tell you that at the end of the movie, there were only 3 Magnificent Seven cowboys remaining, and 4 were killed. And as we
Yes.
speak, over the last several months, there have been several of the tech giants that have faded quite significantly. And today, the only ones standing are NVIDIA, Meta, and Amazon. The others have faded in the background and are being overtaken by other companies in terms of
Mm.
performance. So just like the original movie, we're having that experience today as the
Yeah.
market widens out and involves more companies.
Well, you knew Yul Brynner and Chuck Bronson were going to survive,
Yes, of course. Chuck didn't make it.
didn't he?
No. It was Yul Brynner and Steve McQueen
Oh,
and
yes.
the young cowboy who fell in love with the girl.
What a loser. Anyway.
Oh, cowboys falling in love with young girls are that's not they're not losers, Alex. Okay.
What do you mean? He's got to ride from town to town, Bill. There's opportunity in every town, in every port.
Oh, you're talking to a guy from Texas. That's where we want to be. Actually, at the end of the movie, we want to be in love with the beautiful young maiden, and then right off into the sunset. Man, come on, are you kidding me?
I suppose
Listen,
my wife
there's
doesn't
a
listen
lot of
to this,
stuff to
so
talk about here, and I really want to get to all of it. But I tell you what, I think we should do. I think we should break this at this point, and then come back and pick up this discussion with a topic that I happen to like, which is fate of blue chip stocks, and get into some more biases along the way. But for the moment, I want to break it here, so we can resume this conversation in the next episode. And that's an opportunity for me now to remind everybody who's listening to this who is not a subscriber that you should be one, because you don't want to miss the next episode. If you subscribe, you'll be automatically notified when John and Alex put out a new episode of the podcast. So hit subscribe. We'd also ask you that if you like it, let people know. Let people know about this conversation we've got going on. and we will continue it when we return. Also, if you want to reach out to John and Alex, their information and their contact information is in the show notes. So don't worry about breaking out your pencil right now to write it down. And we will be back next time with a look at fate of blue chip stocks and a way that you might think about constructing a portfolio and what you might want to do in terms of landing that retirement that you're so eagerly are working towards. Until next time, I'm Bill Tucker on behalf of everybody at MedWealth Financial. Thank you for listening. And I'm reminding you that, remember, you can go out today and make it a great day or not. It is your choice. Thanks for listening.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.